I'm going to hand it over to Andrew. And Andrew, take it away. We'll be here in the background if you need us.
All right. I appreciate it. Let's see. I'm going to share my screen. You guys let me know if it comes up here. How does that look? Does it look like it's
It's
pulling
it's
up?
black. We see your screen, but it's black. Oh, there we go.
Good?
Yep. And just,
Okay.
yeah, perfect. All right. Take it away, Andrew.
Awesome. I appreciate it. I appreciate everyone taking some time. Um, we are in a very dynamic insurance market right now. The insurance world is shifting pretty aggressively, and if you've renewed your insurance recently, you've probably seen this. It's getting better, which is something that we've been looking forward to communicating for a long time. I think, going back with you guys, Marielle, with Ace. I mean, going back maybe 4 years, we started teaching kind of a navigating a challenging insurance market course, right? Where the insurance market was just imploding. I mean, for lack of a better way to phrase it, where the concept was, look, we're in the most difficult insurance market on record. Here are some things you can do as board members, as managers, to kind of navigate this more effectively and come out at the end of the day with an insurance program that still works, right? And since the day that we first started teaching that class, I started looking forward to this one, right? So that's years ago, right? But that's
And I think there was a transitioning market. So this is like the first time I've really seen like a healthy market presentation from you, which is really exciting.
yeah, yeah, it is. It's getting much healthier, which is fantastic. I mean, I know I'm preaching to the choir. Everyone on this call is I'm sure intimately familiar with what's happened the past 3 4 years. I mean, I'd say the average, right, condominium association has maybe doubled the cost of their insurance in that time frame. So it's been obviously very difficult. We're kind of starting to see the light at the end of the tunnel. I will say, when we're having these conversations, the caveat always, and it's the same when we're budgeting with our clients, which is basically what we're doing right now. The next couple months, we basically call budget season with our condominium and HOA clients. It's difficult. We have no option other than to budget during hurricane season, right? So uh, obviously, a major storm can change things a bit, and I feel like every time we do these types of conversations, there's some irony because I don't know if you guys have been following, there's a pretty strong looking storm out there right now. It's far away, so we're still a ways out, and most of the models have it kind of turning north, but I guess it makes our this conversation even more relevant. So a little bit about me, and then I'll kind of get into why we're here and what I think the conversation is. This is all I do. I mean, I know Ace, our group, the vendors involved, really truly specialize in working with community associations, which is what we do. Our agency works with roughly 1,300 community associations. I graduated from Florida State with a degree in risk management and insurance. So very specific. It's the only school in Florida that offers that, a true risk management insurance degree. I'm a charter property and casualty underwriter, very involved with the state association for insurance agents, of course, a state approved LCAM CE instructor, and I'm third generation insurance. As exciting as that sounds, family. I've been inside an insurance agency as long as I can remember. My mother was in it, my grandmother was in it. We have our potential fourth generation, but we're early. She's 2.5. She starts preschool tomorrow for the first time, so we're still working on the vocabulary, but she's getting there. And I was born and raised in South Florida, in Palm Beach County specifically. So there's not too many of us, but I Palm Beach County native. I've seen quite a few storms and different insurance markets, and and cycles. So the way that I thought made sense to kind of break our conversation up, I think it's important for everyone to kind of understand the context, right? I think it's one thing for me to tell you the insurance market's getting better, but I think it's critical that everyone kind of understands how we got there, right? And what's actually changing the insurance market. And what I found kind of the past 4 years when the market was difficult is that everyone knew that premiums were going up, but our industry kind of as a whole, I felt pretty strongly was not doing a great job communicating why, right? If I'm on the board for my community, if I'm managing a community, I think that part of it's pretty important. So that'll be a piece of our conversation. I want to kind of talk through generally what we might expect, right? So knowing that the insurance market is getting more favorable, what does that mean? What should we look out for? What's going on with Citizens, which is obviously um, relevant. Citizens is the state market for property insurance in Florida, and when the private market becomes healthier, Citizens tends to operate very, very differently, which can be frustrating. So we'll talk about that a little bit, and then the liability market we'll talk through briefly. I Most of our conversation is going to be around the property insurance. For most associations, that's the majority of annual insurance budget or insurance spend. I mean, we're talking 80, 85, 90% of the budget is the property insurance. So we'll talk about that. But then there are some nuances to what's going on in the liability world as well, which is no less important. So the first thing I always emphasize when we're talking about insurance, why is the market changing? Why are premiums going up? Why are premiums going down? It's an incredibly cyclical industry. It always has been. This goes back decades and decades and decades. If you looked back over a long stretch of time at your association's insurance premiums, you would definitely see periods of years where premiums have gone up and periods of years where premiums have gone down. Now, I'm not saying that it's proportionate. We've never seen anything like we just saw the past 4 years. And I don't know that this soft market, right, that it looks like we're heading into gets us back to where we were. But it is, I do feel again, I guess subject to hurricanes, right, that we are definitely heading into a softening market or a buyer's market for insurance. Now, when when we talk about what drove the past 4 years, right, the hard market or the difficult market, there's a number of different kind of drivers to that, and I think this is important for everyone to understand because again, it's the context. And when we talk about why insurance premiums are going down, what's been fixed, what's changed, the only way to understand that is to understand what the issues were, right? That were making it difficult. So the first one is kind of the most obvious one. This is what most of us are going to think of when we think of why might insurance premiums be going up for the past 4 years. And it was losses. I mean, there's been a significant increase in insured losses. Now we think of hurricanes, right? Because we're Florida, that's our catastrophic insurance exposure. But the insurance market is very global, right? It's not even just national. It's truly global. So it's hurricanes, but it's also things like wildfires and earthquakes and tornadoes all do influence the more broad insurance environment. So to kind of put that into perspective and to kind of emphasize what the trend has been, this map is from the NOAA, It's a neat map because because each of these dots on the map, each of these symbols are separate $1 billion insurance events, right? So whether it's a fire, hurricane, tornado, each of these dots cost the insurance industry $1 billion or more in covered losses, right? Paid out losses. The reason this is interesting is because if you look at the historical trend of how often this actually happens, if you were to look back going to 1980, right? So from 1980 to 2023, the average number of individual billion-dollar events in any one given year was 8.5. So that's a 43-year sample size. So over 43 years, on average, the insurance industry saw 8.5 $1 billion events. If you look at 2019 to 2024, so recent years, the average is 20.4. So on average, from 8.5 to 20.4, it's a dramatic increase in how often these significant insurable events are happening. It's 2.5x compared to what it historically has been. So insurance companies have been adjusting for that. And then recently, obviously, the tornadoes that we had not too long ago and the wildfires in California. I Those California wildfires obviously were very publicized, and those were obviously catastrophic. Most I've found that most of us though don't realize how catastrophic. I mean, those fires cost 40 billion from the insurance perspective. So those were the costliest fires on record for the insurance industry by a mile. It's obviously very relevant because the insurance industry is not only seeing an increase in how often we're seeing these significant events, but also the severity, meaning how significant they get. Inflation has also been a really uh, significant driver of why we've seen insurance premiums go up. Most of you have seen this, right? I mean, obviously we see it everywhere. It's not just an insurance thing. Grocery store, right? It's talked about frequently, right? It's the cost of goods, but where we've seen it specifically in the insurance industry and specifically for community associations is updating appraisals, right? Usually when we're teaching this class in person, I always do a show of hands how many of us have updated our appraisal in the past 36 months, which is all of us for the most part, and then how many of us saw our values go down. And not many hands stay up because what we've seen is an increase in the cost of construction, material costs, labor costs. So what's happened is not only have your associations been having to buy insurance in an environment where the rates are going up, right? Meaning the cost per dollar of insurance is going up. You've also been generally having to buy more insurance because if your appraisal, if your insured values go up by 10%, not only does the insurance cost more, but you're also having to buy 10% more of it. So this has been very relevant. I will say we've started to see these increases come back down to earth with the appraisals. We're not seeing these major 20%, 25% increases with the insurable values anymore, which is helping kind of mitigate and kind of bring us back down to a healthy insurance market. And then this one is kind of the final driver as to why we've seen such significant increases. And to me, in my opinion, this is the most significant one. I mean, even more so than the losses we just talked about. Florida, and I know I'm probably not going to surprise anyone, has a major problem with litigation and with frivolous litigation. And unfortunately, it tends to get more more prevalent the further south you go. But I don't think this is something that most of us are not aware of. You don't have to drive very far down 95, right, to see the billboards. And I know that this is something that most of us are aware of, generally, but what I've what I've found though is that the scope of this is not necessarily communicated as effectively as it should be. And what I a great example of that is our insurance commissioner. Every year he does like a state of the union for insurance, right? Here's what's happening in the market, here's what's wrong, here are the issues we're working on. And a statistic that he started referencing in 2019 was astonishing. And he's referenced it every year since, and it's been in every article about that kind of touches on the state of the market for the past 5 years. But the statistic reads that Florida buys about 8% of the property insurance in the United States, but roughly 76% of the country's property insurance litigation has been concentrated to Florida in recent years. So, three-quarters of the country's property insurance litigation, one state. That has been catastrophic to our insurance market. And this, to be honest, I think is the reason we've seen so many carriers leave. I mean, I think something like 18 insolvencies or carriers leaving the market within 24 months. Prior to this, to kind of the midpoint of 2024. So this has been unbelievably problematic. It's been addressed. So that's the silver lining, right? Is that it took a while. In my opinion, it took, I don't know, 18 months too long. But that being said, our legislators did uh, make headway towards that, right? Towards tackling the frivolous litigation and the fraud that happens in Florida. And one of the things that they did in 2023, there were a couple of bills that were passed that kind of were targeting this practice. And something that they eliminated in these bills was one-way attorney's fees. Now, the way these have historically worked uh, was that in Florida, if a policyholder sued their insurance company, right? If they said, we don't feel like you're handling the claim well or you're acting in bad faith. If a policyholder went on to sue the insurance company was prohibited per Florida statute from pursuing any sort of legal expenses following that, no matter what. So doesn't matter if it was entirely frivolous, legitimate, doesn't matter. Our statutes have historically been such that the insurance company is not able to come after defense costs no matter what. Now, this is this is always a sensitive conversation because obviously at face value, the intent of this statute was consumer protection, right? It was if you have massive insurance corporation and an individual policyholder with a dispute, right? A legal dispute, how can we kind of level the playing field? And the concept was okay, if we prohibit the insurance company from coming after defense costs, that's a step in the right direction of giving the policyholder an advantage. Now, the problem with that is like anything else, there was a handful of legal firms, that got exceptionally good at exploiting this. And basically the way that they were doing this was the unscrupulous attorneys and the unscrupulous public adjusters were basically going door to door after a storm or even years after a major storm and saying, sign here if we sue your insurance company, we can try to get you a free roof, right? Whether there was damage or not. And the insurance company can't come after defense costs, the legal fees, and we will work on contingency. So the pitch was, okay, there's literally no downside. Let's sue the insurance company and see what happens. So that was very challenging because, again, the intent was good, but it got to the point where some of these firms were, I mean, signing up thousands of policyholders at once to do this. So that that was a very relevant piece of what was kind of creating a very challenging underlying legal world, right, for these insurance companies to operate in. So this has been eliminated. The one-way attorney's fees, along with a number of other mechanisms, were completely eliminated with some of these bills that were passed in 2023, which is why now we're starting to see companies come back to Florida pretty aggressively. I mean, the competition is increasing dramatically, which I always say insurance is like any other market, right? It's economics 101. The problem with the past 4 years is that insurance companies were leaving, meaning competition was going down, right? So when supply is going down, the cost of the product naturally is going to increase with less competition. But now, with more companies entering the market, the inverse of that is true. With increased competition, it's driving premiums down. There's more options for associations. Our conversations, our renewals, thankfully, are no longer here's your citizens renewal and that's the only option. It's a very different environment. So now, one of the questions that I get asked a lot, and it makes sense. I mean, it's logical. I would ask it on the other side is why did this take so long? We're sitting here today, August of 2025, talking about bills that were passed in January of 2023, right? So that's a big gap. I mean, that's over 2 years since this tort reform actually got passed, and there's an interesting timing perspective to this, and for context, if we go back kind of to January of 2022, in May of that year, right? So this was kind of middle to peak of the hard market of when insurance premiums really started getting out of control. In May of 2022, our legislatures did call a special session to talk about this, right? So it was on the radar. There was a lot of noise. We were communicating frequently with Tallahassee to try and start this conversation. So they met in May. Unfortunately, they basically kicked the can on the whole thing in May, right? So it's not surprising. So that happened in May of 2022, and then September of 2022 is when we had Hurricane Ian on the West Coast. And that storm, it's crazy that we're coming up on 3 years removed from that storm. It that feels like it was yesterday, and I'm sure it does for a lot of you as well if you're on that coast. But what happened was we had that storm in September, and it was catastrophic. I mean, it's one of the costliest insurance events in the history of insurance. Not even just hurricanes. So that happens in September. Fast forward, December of that year, our legislators met again following the storm and put this tort reform into place, right? So these bills pass. The challenge, though, is that these bills were passed going forward. They were not retroactive. So the problem was that between September and January 1st of 2023, 708,000 Hurricane Ian claims were filed. Now, obviously, a ton of those were legitimate. A huge percentage of those were legitimate. It was a catastrophic storm, but a lot of them also were not. And I I say that because I mean I had conversations with attorneys and with public adjusters who were renting office space on the West Coast. I mean, coming from all over the state to go over there and and sign up basically as many policyholders to sue their insurance company as possible following that storm, right? So, and I should have prefaced, I mean, this is it genuinely is a handful of adjusters and attorneys that were operating this way. But so between September and January, these claims were filed subject to the old rules. So even though these bills passed January 1st, there was this wave of almost 750,000 claims that kind of had to work their way from start to finish, which they have. Um, and that's kind of why there was this delay in in uh, in the shift to a healthier insurance. Now, the good is that this is working. I mean, we're seeing that in the numbers. This graphic I just put up here measures DCCE ratios, fancy insurance phrase, but it basically measures the amount that an insurance company is spending litigating claims, right? So, uh, post tort reform, we're seeing roughly a 63% decrease figure. 63%. So that's a huge drop in how much insurance companies are spending litigating claims. Um, we're also seeing significant decreases in the amount of claims even filed, right? So we're seeing a decrease in the amount that insurance companies are spending litigating claims when they are filed, but we're also seeing a decrease in these claims being filed at all, right? So with these new rules, it's a little bit less attractive for the attorneys and public adjusters to pursue these illegitimate property claims. And we're seeing it. I read an article a couple weeks ago, and it was interesting. I mean, it was specific to Morgan and Morgan, and it was referencing their property insurance practice. And since this, they've shrunk that practice has shrunken dramatically. I mean, from something like 35 attorneys on staff to 5 specializing in property insurance litigation. So it's a big difference. And what this is leading to is a dramatic increase in competition. So I mean, we're at something like there was 2 more companies that entered Florida and got their approval 2 weeks ago. So I mean, I think we're at something like 11 carriers that have come into Florida, and I should be more specific. 11 carriers that have come into Florida looking to write insurance for community associations, right? So it's one thing for insurance companies to come in looking to do homeowners insurance, right? So single family homes or individual units. It's a different thing for insurance companies to come in looking to do the property coverage again for condominium associations or homeowners associations that have insurable values of 10, 20, 50, 100 million, right? So that's a lot different. um, that market, particularly if you're on the water, has always been limited. It always will be limited, but it's a great sign now that there's numerous companies coming in, seeing Florida as an opportunity again. Now that these kind of mechanisms have been adjusted. Here's an example of that. Now, of course, I preface this with not everyone's renewal is going to look like this, but this is a real legitimate renewal that that I did a month and a half ago. And this association last year, the property coverage was with Citizens, it was literally the only option last year. It was Citizens or no coverage, unfortunately. So fast forward to this year, and this is only a 12-month difference, right? When we renewed this year, we had seven different options, seven different insurance companies. Now, um, the this was a little bit of a unique scenario. The association did have relatively new roofs. It was inland, middle of the state, but still, I mean, to go from one option the year prior to seven this year, it's an example of obviously a very healthy year over year difference as far as what the market is providing. So with regards to Citizens, I always talk about Citizens when we're talking about the market because it's Citizens is a great indicator typically as to how the market's doing, right? Citizens is the market of last resort. When the market is when the private market is healthy, Citizens shrinks their policyholder count. When the private market is difficult, Citizens policyholder count grows, right? Which makes sense because there's less options elsewhere. So the market of last resort for Florida um, increases and becomes more relevant. Now, if you look at these trends, if you go back to 2019, Citizens got down to 421,000 policies in Florida, right? So that was kind of peak soft market. That was right before we started seeing insurance companies talk about increases and then start taking major increases. Fast forward to September of 2023 is kind of when Citizens peaked. They got to 1.4 million. So they grew from 421,000 to 1.4 million by a million policies. This is why most associations either moved to Citizens or at least had the conversation about moving to Citizens. And obviously there's a lot wrong with Citizens. They're designed as the market of last resort. They're critical. Don't get me wrong. If not for Citizens, we're talking about over a million policyholders that probably wouldn't have had coverage the past 4 years elsewhere. Um, so they're necessary, but the they grew rapidly. Now, fast forward to today, Citizens is shrinking dramatically. So a lot of us on this call have probably been able to move coverage away from Citizens in the past 12 months to one of these newer companies or one of the legacy private market companies that has started writing again. Um, that's something that's been very refreshing because we don't enjoy working with Citizens. I mean, that's the reality. It's the state program. They can be very difficult to work with. I always, as an analogy, kind of say it's almost like if you were buying insurance from the DMV, in that they're not overly flexible. They have their required documentation, they have their guidelines, and if you qualify, great. If not, you're not going to be eligible. So that's one of the things that um, is very relevant with Citizens because it's also important that everyone understands their Citizens' behavior changes dramatically when the market's getting better, right? So when the market was getting difficult, right? When we were starting to see associations having to move coverage from the private market to Citizens, Citizens was much more agreeable or willing to work with us or flexible, however you kind of want to put it. What we're seeing today is night and day different. And I may strike a nerve with some of us on this call if you're dealing with Citizens right now, or if you've had a contentious situation with them in the past 12 months. But they right now are behaving in a way where they want policyholders to move, right? Which in their defense, on paper, that's how the program is structured. It's backwards. In a perfect world for Citizens, their business model would have zero policyholders, right? The dream for Citizens is to not have a single policyholder. Now, it's Florida, so I don't know that that ever happens, but they're definitely depopulating right now, meaning they're making it more difficult to qualify for Citizens. They're not making exceptions, and that's working. I mean, Citizens has decreased their policyholder count significantly. Remember, they were at 1.4 million in September of 2023. The last numbers I looked at, I think they were somewhere around 850,000. So big decline. I mean, we're talking about 500,000 policyholders that have moved from Citizens to the private market. So, I mean, the reality is that the Citizens depopulation effort combined with the private market becoming more competitive, I haven't had a renewal in the past 12 months where Citizens has been the only option. I mean, there's multiple, you know, companies that are targeting this type of business. Now, what I mean when I say Citizens is behaving differently, and I think this is important for everyone to know. The reason is because if you are still with Citizens, I think it makes sense to kind of have your arms around the shift in their behavior and the shift in their operations, so that you know what you might be up here. Um, so one of the things doing with appraisals, they're now requiring, first of all, if you're a homeowners association, Citizens requires you to include the interior items no matter what, even if your governing docs don't require that. So things like cabinets, fixtures, appliances would be the master association with Citizens, which is unusual if the docs don't say that. If you're looking to qualify for Citizens new business, meaning move from the private market to Citizens now, you have to have an appraisal that's no more than 12 months old. So it doesn't matter if you're an HOA, doesn't matter if you're a condo, and the statute 718 says you have to update every 3 years. Citizens is saying every 12 months now. They're getting very strict with the milestone inspections. And here's the big one. Here's the one where I may fire some of you up if you're dealing with this, because I know I've dealt with it numerous times. Citizens has become relentless with the roofs. I mean, very, very strict, very aggressive with roof condition, roof age, the way that the inspections have been done. And what I what I mean by that, to give everyone an example of what we're dealing with here, and I know this is a silly example, but it's a great example of kind of the logic or the behavior that we're having to navigate with Citizens right now. So 12 months ago or so, Citizens sent out a bulletin to all agencies, right? That basically stated going forward, they are not going to accept any roof inspections, any roof documentation if the photos were taken with a drone. Okay. So my response when I talked to Citizens about this was, okay, if you could please, if there's any sort of supporting logic or documentation, it'd be helpful, because my question to them was, you're getting the same exact picture, right? If someone flies a drone 6 feet above the roof and takes a picture, I mean, it's the exact same picture. There's literally no difference between what you're getting with that and with an inspector actually going up on the roof and taking the photo. It's the same angle, everything. And the response from Citizens was basically just, if we don't see a shadow in the picture, we're not taking it. So it's very challenging because Citizens is taking stances like that right now, where there's not necessarily a ton of supporting logic driving it. Um, and it's not helpful. I mean, think about the level of efficiency, right? When you talk about, I mean, some of our associations have over 100 buildings. I mean, garden style condominium associations where the difference between an inspector being able to fly a drone up there and get pictures of every building as opposed to having to climb up and take pictures on every single building is is major. I mean, we're talking about days of taking pictures as opposed to a couple of hours, not to mention the safety. I mean, the difference in safety with a roofer having to climb up on 100 roofs is pretty relevant. Some of them won't even do it. I mean, I've had some really tough conversations with roofers about this. So um, this again, I know it's a silly example, but it's kind of one of those one of those things where this is the type of operation that we're dealing with, and then the kicker is the citizens inspections that they're doing. They're using drones. So it's frustrating because it's different rules on both sides. But I emphasize this though because citizens on paper, their guidelines do say for flat roofs they want 15 years or newer, and for hip or gable roofs they generally want 20 years unless it's or depending on the type of roof covering. So I only emphasize all of this with citizens to basically say pay attention to it, right? If you're with citizens right now, I would encourage you sooner rather than later to start having some pretty detailed conversations with your agent about what to expect this year, not only with alternatives, right? So, and we call this time of year budget season, right? I'd say 75% of my day to day right now is budgeting with our clients. So in those conversations, it's important to talk about not only the private market alternatives that may be there, but also what are we expecting from citizens this year? And I know that from the agent perspective, that's a tough question to answer. I mean, I'll be fully transparent because citizens changes daily, based on I don't know how the underwriter slept. Sometimes it seems like, but it's a conversation I'm always happy to have though, because as part of our budget process, we do communicate with citizens if we have associations that are still there to say, are there going to be any issues? Because if there's an issue with the roof, man, if we can start that conversation 7 months in advance, 8 months in advance instead of a month, it gives us a little bit more room to maneuver, and it can be pretty critical. So um, I know I'm going to run out of time, so I'm going to kind of start bouncing around a little bit. I want to make sure we have some time to talk about the positive, right? I know all of that context is important. My intent was to kind of help prepare everyone as best I can, kind of with what's changing, but then with regards to the private market, first off, and again, I know I'm maybe beating a dead horse, but the caveat is hurricane season. If the wind doesn't blow, I think this trend is going to continue and basically snowball. And if that happens, then there's definitely some things that I would encourage everyone to look for this year and to make sure that uh, you're discussing, because a lot has changed in the past 4 years, right? It hasn't just been premium increases. There's also been a lot of negative coverage changes, right? So yes, if the wind doesn't blow, I think we're basically going to see premium decreases across the board. So obviously that's very important. It's going to provide some breathing room for everyone with after what we've seen in recent years, but just as important is we've lost a lot of coverage in the past 4 years, and an example of that is that a lot of insurance companies have started to change the way they value uh, roofs specifically, right? So when I say that, there's basically two ways an insurance company can value your building or your roof or pay a claim, right? And it's either based on replacement cost or actual cash value. And the difference between those two is actually very simple. It's depreciation. That's it. Right? So if you have replacement cost, what that means is that if you lose your roof, your carrier is going to replace that roof with a brand new roof 2025 of like kind or quality. If you have actual cash value, what that means is that instead of putting a new roof on, the insurance company is going to depreciate the value of the roof and cut you a check for that depreciated amount. It's a huge difference. I mean, if your roof is 15 plus years, when you talk about depreciating it, I always use a TV as a pretty relevant example, a pretty relevant depreciation example, because uh, if you think about a 15-year-old TV, right, and a TV today, they're not the same. They're different, and frankly, roofs don't depreciate much differently than TVs. I mean, 50-year-old, you're talking about pennies on the dollar, if any. It's a major coverage difference. And what I will say is that the past 12 months, all all of our renewals where the insurance company has pushed actual cash value in the past 3 years, they've changed it back. And this is kind of a peel back the curtain a little bit kind of behind the scenes. It takes additional effort. So the quotes don't always come in with replacement cost, but this is this is an example of a renewal that I did in this was actually in January, so this is a while back, but um, our renewal came in with actual cash value on the roofs. And here's how simple this is. I mean, my correspondence with the underwriter was basically once we had that, once we reviewed it, the conversation was, can you please have the insurance company adjust to replacement cost on the roofs? And the response was same day, yes. It's basically, here's your revised quote with replacement cost on the roof. So I emphasize that so that everyone knows, and I know again, this is kind of behind the scenes, but make sure you're asking these questions. And if your renewal is coming in with the same terms that you had last year, or a change in terms that's not favorable, there's nothing wrong with pushing back on the agent. And I appreciate it when I have the conversation with our clients. This is the time where we should be looking to increase the coverage. There was no additional premium for this change. So we're starting to see those types of changes. Ordinance or law is another one, and ordinance or law is coverage for code compliance, right? So if you have a loss, right, if your association were to experience a fire, hurricane, you would have to bring the building up to 2025 building code, right, when you're repairing or rebuilding. That can get majorly expensive. I mean, we're talking wiring, plumbing, impact glass. There's a lot that you'd have to do to bring the building up to code. And in the past 4 or 5 years, during the hard market, while premiums were going up, we saw companies start reducing the amount of ordinance or law. Or Citizens, for example, literally just doesn't even offer it to anyone at all. So it's a really important coverage because if you don't have ordinance or law, the insurance company is going to pay to replace the building as is. But then if all of a sudden you have to start installing impact glass and doing all of this extra work to bring the building up to code, that cost is significant. So right now, a lot of companies, if not all companies, other than Citizens, of course, are starting to offer this again or increase it again. So I would encourage you to push on that. And I know so the other the other coverage change that we've seen kind of over the past this time frame is a pretty significant increase in deductibles, right? So what we've seen a lot of companies do, and this is probably going to be familiar to a lot of you, is if you had a 3% deductible or even a 2% deductible for hurricanes, meaning the deductible for hurricanes is significant because it's a percentage of your insured value. So if you're a $40 million building, right? If you're a $40 million high rise and you have a hurricane, your deductible, if it's 5%, is $2 million. So it's pretty major. And we've seen a lot of these insurance companies increase that during kind of the hard market cycle. So if you've gone from a 2% or a 3% to a 5%, I would encourage you to have that conversation as well to see if there's a lower deductible option out there for you. I mean, I know this sounds crazy, but if you push on this kind of stuff, a lot of these companies, because of the increased competition now, right? That's the key. They're operating differently because of the competition. I had a renewal last week where we had multiple options. It was a significant premium reduction, but then kind of the final differentiator was we went back to our incumbent company and said, look, there's competition this year. It's no longer you and no one else. If you're able to offer a 3% deductible, it's going to differentiate you from everyone else because it's no longer just a pricing conversation, and they did it with no additional premium. So think about that from the perspective of a $40 million building. It's major. I mean, it's almost $1 million reduction in the deductible if you have a hurricane at no additional cost. So I encourage everyone to push on those types of items. The calendar year hurricane deductibles are also starting to come back. Um, what a lot of insurance companies did is during the hard cycle, they moved to per occurrence hurricane deductibles. And that's exactly what it sounds like. It means if we have more than one storm in one hurricane season, you have a brand new deductible for every storm. So in our example with a $40 million building, I don't know if anyone was here in 2004 like I was. That was basically hurricanes back to back for 45 days, right? This was the year we had Charlie, Francis, Ivan, and Jean, and I guess technically five. If I can't remember which one it was, but one of them went into the Gulf and came back and hit twice. But if you had a per occurrence deductible in our example, every one of these storms, $2 million deductible. Charlie, 2 million. Francis, 2 million. Ivan, 2 million. But with a calendar year deductible, it erodes throughout the year, right? So it works the way medical insurance does, where if we have Hurricane Charlie and it does $2 million worth of damage, our deductible is gone going into the next storm. So very significant. Another example of something that insurance companies are very agreeable to including right now. Um, I know we're running short on time. I want to take questions, but so to kind of summarize the property world right now, it's very competitive, right? So I would encourage everyone, and my goal for this conversation was basically um to to position everyone where not only are we giving you some things to look out for that could result in a more efficient insurance program for you at the end of the day, not just cheaper. Hopefully, I'm communicating that your mindset going into this renewal should be okay, basically game on, right? This is a buyer's market. How can we not only end up with the cheapest insurance program possible, but also how can we increase our coverage, right? Because the opportunity is there to do that right now. So I would encourage everyone to have a pretty thoughtful conversation, right? Don't just be happy because the premium's coming down. You can accomplish that, and you can make the insurance program more efficient at the same time this year. So real quick, I'm only going to take a minute on the liability, because the liability market is still remaining pretty difficult right now. The good news is that the property market is very healthy, and that's 90% of your premium. So even with the difficult property, or the healthy property market, and a still difficult liability market, if the property's going down, your bottom line is going to go down no matter what. I mean, it's too big of a percentage of your budget. But just so everyone knows, we are still seeing a difficult liability market, where insurance companies are still seeing an increase in slip and falls and those types of claims, right? So we're seeing a significant increase in kind of what insurance companies call nuclear verdicts, meaning $10 million or more. So where maybe an insurance claim where someone got hurt would have settled for, half a million 10 years ago or 15 years ago. There's this phrase called social inflation, where there's been a lot of these nuclear verdicts where they're 10 million, 20 million, 50 million, for someone who was catastrophically injured. And what's happened is that precedent. So now, because any of those, when there is a major loss, um, a lot of these juries are starting to look past verdicts, right, for reference. And so it's kind of created this environment where um, juries are quicker to award those nuclear verdicts. So this is something that's still very much fluid, and that the insurance company is kind of actively trying to navigate. But on the liability side, we are, and this is kind of the general liability, directors and officers, and the umbrella, we are generally still seeing minor increases right now. But again, the silver lining is that the property market is very healthy. So again, and disclaimer again, hurricane season, but if everything goes smoothly and the property rates continue trending the way they should, the vast majority of our clients are going to see significant premium reductions this year, which is obviously positive. So I know that's a ton of information, and I know I jumped around a little bit, but uh, I'm happy to take any questions, Mariel. I don't know if anything came in.
Yeah, we have a few questions, some
Sure,
commentary on some of the things that you brought up, which is funny.
sure.
I just want to mention before we start that the evaluation form is in the chat for you guys. So go ahead and fill it out. You're going to have an opportunity upon submitting that page to have Andrew's contact, which is also on the screen. You can contact him directly to get a copy of the presentation. But I want to reiterate that the recording of this webinar will be on the acebytsk.com website as well, just like past weeks. So go ahead, I'll put it in there one more time. If you haven't seen it yet, please go ahead at the bottom of your screen, click the chat button so that it appears. I'll give you just a couple seconds. Go ahead and click that chat button, and I will go ahead and send it your way. All right, I'll send it one more time just at the end. All right, so let's jump into some questions. We have George. I understand that there are global losses that have to be covered. The issue I have is that the insurance company's ROI have been phenomenal over, say, the past 12 to 15 years. Their gains from stock market, hedge funds, FX have been in the hundreds of billions, far more than losses. Again, just kind of, bolstering some of
Sure.
your earlier points.
Yeah. Yeah, that's true. There's insurance. There's a lot to unpack with insurance. There's a lot of private capital that's also involved, George. So you're not wrong. But the reality though is that we're finally starting to see kind of a shift to a more healthy environment in our world for the policyholder.
Margaret, I'm seeing on Facebook ads for suing your HOA. This is not going to help. This was to part of your early conversation at the top of the hour. Yeah. Um, George again. I think George has a couple. He's along for the ride with us. So he says I have to laugh every time I hear. Well, it's only a handful of attorneys who ... Their corruption is exceeded only by the medical professionals. You know, and he gives some examples. Next cottage industry will be lawsuits over ADA websites. So, you know, I think you have some people who are, you know, feeling that.
Sure.
And then he goes ahead and says next, you know, is the Citizen CEO's brother a roof photographer, which I think is hysterical.
It's a fair ask.
Yeah. You would think. Colleen, barrel tiles and already on ACV, Florida won't give RCV per the agent. You may know what this is referring
Um,
to. I'm not totally sure.
yeah, um, so Colleen is basically saying that she has actual cash value, which is that depreciation on her roofs right now. But I don't, I think maybe I'm missing some context, Colleen, because I
She
know,
says N 2006 in the second comment. I don't know if that's
oh
helpful.
yeah, I was gonna ask how old they were.
Okay, there we go.
I, I don't know. I mean, Colleen, obviously, I haven't looked at anything with you guys, but I think your second point here, where you say Florida won't give RCV per the agent. I mean, I think I'm misunderstanding something there, or there's something missing because that's too broad. I mean, Florida, you know, definitely there absolutely are carriers that are doing replacement cost RCV. So I don't know. I mean, my contact information is on here, Colleen. I'd be happy to have a specific conversation later if you'd like.
Awesome. Thank you. Thanks for that offer. Kathleen, great job, Andrew. We at CMO love you. You are an asset to any association you serve. Thank you. That's awesome. Thanks
Oh, thanks,
for
Kathleen.
joining us. Kirsten, if you have an insurance agent currently engaged in a contract, can a COA get bids from another agent and or company?
Yeah, this is a good question because this is always confusing, right? The insurance industry, when you're talking about shopping or bidding, it is night and day different than any other relationship that you guys are going to have in that these insurance companies, all of them, right? They will only work with one agent no matter what. So it actually it goes even a little bit further. They all also provide the same pricing to every agent. It's very regulated. So what that means is that Kirsten, if you have an agent, right, and they're working with, let's say, American Coastal, I would not be able to go to American Coastal on your behalf and get a quote. So the way that the industry is set up, it's structured such that the board is put in a position to select the agent that they trust to best represent them. So I always encourage everyone, I mean, even my own clients, if they, are being transparent and ask me, as far as shopping goes, what I would say to do is interview insurance agents, right? You're selecting the agent you want to work with that you feel is going to do the best job, as opposed to, if you were bidding out painting your building or something like that. It's a different model, if that makes sense.
Makes perfect sense. All right, and then we just have a thank you from George for his comments.
Thanks,
And
George.
thanks. And we had some other great, you know, feedback, so we really appreciate it. Other than that, I just want to remind you guys, I'm going to put the evaluation form in the chat one more time.